Welcome back. I'm here with Gino Littlestone, the Executive Vice President of Alliance Insurance. Did I
Yes,
get
sir.
that all right?
That is correct.
We've known Gino for quite a while. He does a lot of insurance business with our clients. He's been an incredible resource for us for at least 10 years or so that I've known you, or longer than that. And we're going to talk a little bit today about flood insurance, which is a quirky kind of insurance for us. I kind of wanted to start with the history of flood insurance and what makes it a little bit different, which is that, I mean, to be frank, all insurance to me is complicated because we deal with both the condominium and homeowner association law, who's responsible on maintenance items, but then there's who's responsible on an insurable event, a casualty event. And so that changes. And from a property standpoint, the property insurance standpoint, drywall becomes like the most frequently seen thing. Drywall is damaged, but the association is paying for the insurance on it because the state law says that the insurance has to be covered by that. Or a window. So if we were in our condo right now and the window behind me, generally speaking, was to start developing leaks because of age, that's my job to fix as an owner. But if somebody takes a coconut and throws it through the window, all of a sudden it becomes the association's. So that's always been complicated, a little bit. Flood seems to take that up to a next level, and it's because it's a national flood insurance program. And so, Gino, can you talk a little bit about
Sure.
NFIP? And
Sure. So the National Flood Program was started in the early 70s. It's a federal program, and so specific for condominium associations, FEMA did not want to try and figure out each individual state's guidelines when it came to condominium associations, the way a property policy might, as you referenced. And so what they did was they developed this program, and the policy that we use, it's called, we just shorten it up to be an RCBAP. RCBAP stands for Residential Condominium Building Association Policy. That's why we shorten it to RCBAP, because that's too long to say every time. That RCBAP is the same policy that's used in Florida as every other state in the country. So whether or not you're trying to insure a building here in Florida or New York or California or wherever you're trying to write flood insurance on a condominium building, it's the exact same policy, and there's very little you can do to alter that policy. Really, the only thing you can change is the replacement cost values and the deductibles. And even those, there are limitations on what you can do. And so what FEMA did was they developed this policy that provides coverage for the entire structure, unlike what a property policy would do, which is follow individual state guidelines. And so it's much more encompassing from a coverage standpoint. In most cases, there are certain limitations depending on the style of building. And so you can have a building, like what we would call a coach building that might be what we would refer to as slab on grade, which means the first floor has actual residential units. That would be a little bit different coverage than a elevated structure where you see up and down Gulf Shore Boulevard, for example, that they're all raised. The first residential unit might be 20 plus feet high, and then everything under that is lobby area, meeting rooms, things like that. The intent of the policy is really more for the residential structure under the RCBAP. And so there's a lot of limitations on those first floor units that are elevated structures. We talk about these 17 covered items, because if you look in the actual policy, when you go to that style building, it actually lists out the 17 items that are covered. And so tremendous amount of confusion, especially when Ian hit, because we'd never had that kind of a loss before. We've never had 8, 10, 12-foot walls of water smacking into these buildings. And so there was a lot of confusion on exactly what was and was not covered. And there's, again, some things that potentially can be done to mitigate that. And even as agents, we're learning on some of those things. I mean, I've been doing this for almost 30 years now, and I've had flood losses, but I never had that style of flood loss. And so when those kinds of events happen, you try to back out and debrief and try and figure out, well, what can be done, and talk to different experts of, are there different ways of structuring this? Is there different information we can provide? And I think that's an evolution still on trying to figure out maybe the next time it happens, what maybe we can do different. But I think what's important to understand is that policy, because of the federal nature of it, again, is very limited to what you can and can't do. But the coverages, essentially, if you're talking about and peel away the elevated structures, once you get into a residential unit that gets flooded, the difference is that program is going to essentially cover everything in that unit other than the unit owner's personal property. And for some reason, washer and dryers. Don't know why they peeled those out, but they did. But every other item within the unit that you would normally think wouldn't be covered actually is. Things like floor coverings and cabinetry, things like appliances within the unit. Again, peeling out the washer and dryer. The flood policy actually covers all of those items for the unit for a flood. And let's talk about the definition of a flood, right? Because a lot of times we'll get the comment, well, my unit got flooded out by the guy upstairs because a pipe burst in the wall or their sprinkler system let loose for some reason and water comes pouring down. Flood comes from a natural source of water. Tidal surge, rising water has to come up from below, and it has to inundate 2 or more acres of ordinarily dry land and affect 2 or more units in a building. That's what they will define as a flood. So you have to be careful when you're talking to somebody and they say, oh, my unit got flooded out. As an agent, we have to say, well, let's talk about where that water came from. Did it come from below or did it come from above? Then you can figure out, is this really a flood-related loss or some other water damage?
So when you're talking about it being a federal program, and you mentioned cabinetry and a couple other things. So I've always heard, or I guess when I was first learning about flood insurance, I was in a class and they were explaining that flood insurance it's been a constantly changing program and that they've tried revising it, I guess in like the 70s or 80s or something, and it was running as a loss and they're trying to make it not run as a loss. I don't recall exactly the timeline on it. Later on, we're going to talk about Risk 2.0 and all that, but my understanding is the flood insurance program has actually gone through multiple
evolutions. Gone
evolutions.
Through some evolutions. I wouldn't say anything significant until 2012 when the Biggert Waters Act occurred. And Biggert and Waters were 2 senators that basically stepped in and said, we're gonna improve this federal flood program. It runs a huge deficit every year. I think now it's probably, after the last couple of years, well over $20 billion in losses, or in deficit, I should say. The losses were much, much larger than that. That's one of the reasons why you don't see a really good and flourishing private flood program, because when the federal program runs short, the Treasury saves them. Hartford, Travelers, I don't care what other carrier you want to go to, if they lose, the Treasury's not bailing them out. Yeah. So there have been some changes, but that 2012 Biggert Waters Act was the main change where they came in. And if you've been around long enough, you'll remember when that first got rolled out, they essentially forgot to go through one important step, which was a economic feasibility study. That basically was, what's the impact going to be in the real estate market to individuals if we just start raising rates? When they rolled that out, I remember very vividly, they didn't say anything. The rates in some cases went up 8 and 10-fold. We had properties on Gulf Shore that went from, a high rise at 100,000 to over $1 million in premium. I had properties on the Barrier Islands, Fort Myers Beach, Sanibel, that went from 8,000 a building to 80,000 a building. It was literally going to destroy the entire market. So they rolled it all back. They stopped it. They stopped the increases at least. And then it took them roughly from 2013 to 2021 to figure out some level of what that economic feasibility study was. And like you said, we'll talk about risk rating 2.0. But the reality is the coverages themselves really haven't changed much. The rating system didn't change at all until Risk Rating 2.0 came in October of 2021. So how they were rating and what they were doing was all based on elevation. It was all based on what they called a base elevation and the elevation of the structure, the first floor of the structure, and all the rates were based on that. Once Risk Rating 2.0 came in, it all became based on distance to water. And it's a very, very different animal than what it used to be. From a pricing standpoint, coverages still not so much are different. To be honest, they really haven't had any significant movement in that respect, and I don't know that they ever will. To my knowledge, there's not really been a lot of conversation on it. It is a lot of confusion because of how the program works, the fact that you see, let's say the Hartford, on your policy, but at the end of the day, the Hartford is nothing other than a clerical animal in that type, because all they're doing is handling the policy issuance, to some extent, the fronting of claims. But at the end of the day, everything has to get approved by FEMA. So if FEMA adjusters, are busy and holding things up, that's what holds up the claim settlements and other things. They have to approve everything that gets done. And all the money comes from FEMA. It's not coming from these insurance companies that you're seeing on the policy deck pages. The money actually comes from FEMA.
So when you're mentioning the private market or the excess market, it always has felt a bit like a shadow of Citizens. to me. Back when all of a sudden everybody had Citizens property insurance because it was cheap. I did, I'll be honest. And it was supposed to be the insurer of last resort, and everybody was using it. And then they depopulated Citizens. Do you know if there's ever been a thought about doing that with the NFIP, trying to find a way for private to be able to compete?
Sure, it happens all the time. We get private flood carriers that'll come in and out of the market. Voyager was the last one. Voyager was, I don't know how many years that program was in place, but you've got a program with a company called Neptune right now that is writing things in little pockets. But at the end of the day, they can't compete. There's a term in insurance called an actuarially sound rate. Actuaries are the people behind the scenes that are doing the math, probably the smartest people in the world. They are, I've spoken to a few, and the level of their knowledge and what they do is off the charts. And so the problem is that because the program is not actuarially sound, real insurance companies can't compete with the federal program for that reason, because the losses outweigh the gains. And so that's why, like I said, when the federal program gets into this huge deficit, Treasury just forgives it at the end of the day. Nobody's forgiven the private market. When the private market runs out of money, they run out of money and they go out of business. And so you've had these companies over the years come in, try to figure that out, and none of them have been successful long term. Like I said, you may find some short-term fixes here and there, but long term, they don't ever work. And the other problem is these private markets that come in are all non-admitted carriers. There's no backing financially for them, the way that an admitted market on the property side, the last big one that went under is AMCAP. But the reality is when they went down, FIGA backed it up financially. With a private flood carrier that's non-admitted, if it went down, there's no backing. And when it's non-admitted carriers like that, there's no real requirement for them to stay in the market. If they decide they're losing money and they don't want to be there anymore, they just non-renew everything. So there's that kind of level of issue with those programs. And now more than ever, if you're with one of those programs, let's say you were with the federal program for, you're a 30-year-old condo and you were going along and you had the federal flood program, you're paying your premiums, you're paying your increases, whatever they were, and somebody comes to you and says, hey, I can save you 20% on your flood insurance. We're going to move you to this, let's say, Neptune program. That's great, right? If you're paying premium, everybody wants to save money. The coverages are similar. You do that for a couple of years, and then Neptune
Never
decides
thought about this.
they're not going to do it anymore. You get thrown back into the federal program because that's the only other option.
Now you don't have
grandfathered rates anymore.
No.
Now you're thrown into the new rating system. That 20% you were saving was off of an old grandfathered rate. Today, I would say in most cases, if you're going into the new rating system, it's at least double, if not triple or quadruple what the prior rates were. So it can really be catastrophic. You really have to look at what are the short-term gains that you're going to get versus what the risk is if that program decides to leave, and what's the alternative going to be for you, because the alternative can be really bad in that scenario.
Yeah, I hadn't thought about that because you get that up. And it's interesting how the flood insurance is actually impacting. You mentioned the real estate sales when they rolled that, 2012 debacle. There's a little bit of a similar situation now with sales, because even though folks, if you're in a place that you're on your grandfathered rate, your flood insurance probably doesn't seem so bad. You're paying a couple $1,000, maybe $3,000. Flood insurance can be very affordable. But then all of a sudden when you sell, so he's coming in, they're doing their due diligence, they might be paying $10,000 for that same insurance.
Some people also don't realize, especially on both places. I mean, everybody knows at this point what a broker record is and how you switch things like that. Commercially, you can do that, but from a single-family home standpoint, you can also assume that policy, and it can roll over for you.
So if you assume the policy and it rolls over, you won't get hit with the increase.
I just did that on the home that I'm working on in Alba that's on the river. My rate for flood insurance is like $1,200. If I wrote it new, it's probably that 8 or 10.
As long as the person had flood insurance before.
Correct.
Because what I was just thinking about is I know of a situation where a person is buying a home, and what had happened is the home had been for sale for a bit. The guy just stopped carrying flood insurance on it, and so now
you're starting new.
He's starting new, so he's in risk 2.0, and
very different scenario.
One of the other challenges that we saw, we mentioned Ian, another one of my Hives events. Ian, Irma.
Well,
I know. Let's try to make it through the I's this year, folks. It's 2025. I don't know. Do you know what the I hurricane is? I don't.
I do not. I haven't looked at
probably like
There
an
is
Elsa or something.
There is one.
But let's try to not have it be an issue. But what was last year's? Because we had Helene, and then
With Milton.
I remember Melton.
Yeah.
I remember Helene.
With the eye. I don't know that there was an eye that did anything last year.
Oh, that's good.
I try to move forward, not back sometimes. Some of that, like you said, it can really take you to a dark place.
TSD.
Yeah.
So when Irma or Ian came through and we ended up with flood, all of a sudden condominium associations were dealing with something we really hadn't dealt with before. Drywall is difficult enough for us, but you mentioned cabinets. Cabinets became a whole thing because now the cabinets are damaged because water was, let's say you had 2 feet of water in the unit. Bottom cabinets are damaged. We were ending up with situations where they would pay for bottom cabinets, but not the top cabinets.
Right.
So now we can't match the 2 cabinets together. And we have unit owners who are very upset. You know, they want cabinets that match. And
Absolutely.
I kind of see their point with that.
I had when Hurricane Charlie hit in 2004. Charlie came through, and it didn't damage too much down here, but it was much more of a Sanibel Captiva and then Punta Gorda Port Charlotte for a little bit. Had a lot more damage from that storm. I handled a very large resort on Sanibel at that time. What you're talking about, we had to deal with because they had about, there were, I think there were 6 or 8 buildings as a part of this particular condominium association, and they were right on the Gulf of Mexico. There were 2 or 3 buildings that are sitting right on the Gulf, and there were others that were a little further back, and the ones that were up front were the ones that really took the brunt of the flood. Well, what we ended up having happen was we had a flood loss because of the surge that blew through their sliders and got into some of the units. We had a wind loss because Charlie tore their roofs off. So what we had to do was we had to get the association's flood adjuster, the association's wind adjuster, the unit owner's wind and flood adjuster for that exact reason. Because when that came in, they had damage to their cabinetry as well. But the lower cabinetry, we knew that the flood had not gotten over 3 feet. So all the lower cabinetry was picked up by the association's flood policy. The upper cabinets were also damaged, but that was from the water that came in from the damage from the roofs, from the rain that came in on top. So the unit owner's wind policy picked up the cabinetry on the top. The associations picked up everything on the bottom. So we had all these different adjusters that we had to coordinate, talking to try to make sure that they were getting all of that done. But it gets very confusing when those lines are drawn and the carriers know what the surge, height is. They know what got damaged by what, and they're only going to pay for those items that they're responsible to pay for. Then you have to try to get creative and figure out where the rest of it comes from. In that scenario, though, where the upper cabinets were not damaged at all, there's no, to my knowledge, matching requirement or anything like that. The carrier is only going to pay for the damage on the bottom, and if you, the unit owner, want new on top and bottom, you're going to be out of pocket on the top.
So we were talking a little bit about having multiple adjusters involved. What are your thoughts on public adjusters, particularly as it comes to flood?
Well, I don't think it has to be particular to flood. I had a different opinion, I would say pre-Irma, because as I said with Charlie, I would say, I don't remember how many claims we filed back then, but it was still a significant number. I would say every single one was filed within 12 months and everything was fixed and paid for within 18 months. It was a fairly quick process. Irma was an entirely different situation. And what we learned was, I would say as an insurance agent, my initial loyalty, if you will, responsibility is to protect my client, right? I have relationships with the insurance carriers and I have responsibilities to them to provide them accurate information, to work with them, to help them grow, to be a good partner with them. But at the end of the day, my contract's with my client. And so we want to do always what's best for your client. As in any field, good and bad actors. There's some companies that do a good job, others not so much. And so prior to Irma, you're really, as an agent, I would say most agents, the insurance companies do not care for public adjusters for many different reasons. And just, again, there's good and bad public adjusters. And we learned that as well. And so after Irma, we really learned from that. We looked around and we saw how some of them were acting, what they were trying to do, how they were interacting with our clients, because there was no getting away from them. There was a surge of them that came in, and your clients needed that extra help, quite honestly. And so we spent years after that storm interviewing, talking to, getting to know different public adjusters, because we knew the next time the wind blew, we were going to be in a position where our clients were asking us, A, are we okay to use them? B, do you know of any that are decent? And we wanted it to be a resource for our clients and say, here, look, here's 3 or 4 or 5 of them that we have talked to, worked with, gotten some relationship with. Interview all of them, make up your mind as to what you want to do. I think there's a place for them. I think, would it be the perfect scenario for the insurance industry if that segment didn't have to exist? Yes, but I don't think it's real. I think there are still insurance companies that are out there that don't play fair. And I think you need that other level of expertise. And then beyond that, just from the coordination of the claim standpoint, if I'm a board member, do I want to spend the next 1.5 years, 2 years of my life doing that level of minutia? Probably not. Nobody's paying me to do it. It's a tremendous amount of work. And if you don't have that level of knowledge or education of how to do it, you can put yourself in a worse position by not bringing in someone to help you. So I think there's a time frame. I don't know that it's always necessary right up front. I think the extent of the claim, the size, the level of damage somewhat dictates that. I tell my clients, let's file the claim. Let's keep the carrier on a really short leash. Let's see how they are responding throughout. And the minute that we see things going sideways, if you want to go down that road, go down that road. I don't know that it's necessary, though, to bring them in immediately. I really like to give a carrier the opportunity to do the right thing. And if they do, great, and everybody will be happy. If they don't, bring in the extra help that you need.
So aren't adjusters compensated based on the size of the claim anyway, though?
In some situations, here's the challenge, though, especially in a really large-scale loss, and that's where most times you're dealing with public adjusters. The day-to-day water damage claims or other small things, it's rare to have the need to bring in a public adjuster. It's not usual. It's really always on the large, whether it be a really big fire claim or a hurricane or something like that. No carrier out there has enough internal adjusters, if they even work with internal adjusters. Some carriers always use third-party adjusting companies. Others have their own internal claims department. Regardless of either one of those, none of them have enough in a large-scale cat loss. So they bring in these outside third-party adjusters that I probably shouldn't say this on tape, but I call them mercenaries. Because they are out there and they are here today and gone tomorrow. You've got no relationship with them. They're running to the next storm.
You ever notice they're all from Texas?
Many of them are.
I don't know. I was having a conversation with somebody else about this
Some of these large
recently.
companies are all based in.
Yeah, there's all of these out of Texas. And when you said mercenaries, sometimes it does feel that way because they show up wearing like TDU pants and they look like they just walked off of
Yeah. I had one come to my house
post
after Ian, and they were in full camo gear. I was like, whoa.
Yeah.
The National Guard was coming in. I don't know what that was about. But anyway, yes. So these third-party adjusters come and go. I have heard different things. I have heard some of them are paid based on the size of the claims. You would think that they would have some incentive to get you everything and build that all in there. The change happens when it goes from them into the carrier, and then the carrier's looking at what those adjustments are, and they're not always in agreement. Right now there's several insurance companies that are out there that are having those battles still after Ian, from what that third-party adjuster brought in and what their desk adjuster
That's what I was going to ask. So what is the desk adjuster?
The desk adjuster is the internal adjuster that works for the carrier. So that third-party adjuster sends something in and says, that roof is toast, they need a new roof. That desk adjuster looks at that and goes, they don't need a new roof. It's only that part, that part, that part. The $20,000 claim, not an $80,000 claim. And that's where the fighting is.
Got it. And then usually the third-party adjuster would be fighting with the desk adjuster to try to get that, I'm assuming. It's like the check on the balance, right?
I don't know how much, they really push. Ultimately, the desk adjuster, that's the carrier, they're writing the check. So they're going to get the final say on it. You also have to understand that third-party adjuster may be working on 300 claims. They don't really have the time to spend on any individual claim too much because they're working all those claims, and then what happens? The next storm comes, and boom, another company might offer them another $50 an hour. They're gone, and that's where you start seeing some of the turnover in the adjusters that you've had to deal with.
Yeah.
That now another adjuster gets assigned, and now they want to come out and take a look, and that's where it starts getting really frustrating.
Yeah, and I think we experienced that. We were talking about, I think it was Charlie, but I do remember Wilma and Charlie were just totally different animals than Irma. And actually, when I think back of it, our first claims with Irma actually were okay. It seemed like about 3 or 4 months into the IRMA process is when things started to switch. And we did see a lot of turnover in the adjusters by then, and it became a bit of a mess.
Couple storms that year, and they were bad storms. Some of the companies didn't have the system set up. For example, American Coastal, they had real issues because what happened was all of their files were paper files. And so what was happening was the initial third-party adjuster might not relay all the correct information into the carrier. And so the desk adjuster is working off the information that's coming in from the third-party adjuster. And so if that's incomplete information or something's not right about it, or they skip town before it's all done, they're sitting there with nothing and they've got to start over. So they went through an enormous revamping of their system of digitalizing everything, making sure that going forward, now when an adjuster comes out, they've got an iPad, they're inputting everything, it goes into their server. They're capturing all of that firsthand as opposed to, but you see that. I would not say it's an exact science. I think it's an evolution. I think carriers learn, and every time just like we do, we look at everything and we try to figure out, but what could we do better on the next one because we know another one's coming, and how do you fix some of those problems that you run into? Heritage ran into that after Ian. They ran into a lot of issues. They ran into issues after Milton. They've been revamping their claims division and trying to improve on how do they do it better every time. But those are the companies that we look to where we go, okay, that's somebody I'm going to trust a little bit more because we do see them trying to improve and make things better as to, opposed to leaving it static when we know that there are other issues returning. So we look from that standpoint from a carrier partnership as to who's looking and evolving and trying to make things better after those kinds of things.
So one last question before we take a break. When you're renewing flood insurance, and I think that this becomes, the only reason I think this comes into question is when we renew our property insurance, there's a property appraisal and we always just go with whatever that property appraisal is. With flood insurance, there's a flood value that's in that appraisal. But flood insurance has this kind of red herring where they have the options, option A and option B. I was always taught you check option A. Actually, I was basically always taught you just pay option A and it'll solve itself.
Right.
And the reason for that being that there should be a flood value somewhere that's supporting this. And at the end of the day, that's the value that you're insuring to anyway. Why is there an option A and option B? Should we be selecting option A or option B?
So option A is the current value. Option B is a slight increase in the value. And so there's a very minimal increase in premium.
Well, it depends on the problem.
Depends on the problem.
Yeah.
Usually it's not significant, but either way, we prefer, and I think part of this depends on how often are you doing your appraisal. I much prefer to control my values with my appraisal that I've paid for from a third-party, professional appraisal company, as opposed to letting any carrier tell me what I should be insuring to. And so we like to use option A as long as you're getting an annual updated appraisal. If you're playing the 3-year game with the appraisals, now you might want to consider option B because there's a slight inflation guard in there and it'll give you potentially a little more coverage. But even then you have to pay attention because if you've maxed out your values at the full $250,000, per unit, it's not going to make a difference. And usually
well, you have an option B at
they'll
that
still be there, but
Oh, it will?
They'll still show them, but it's the same thing because you can't do anything.
Oh, okay. Yeah, so it'll just be the same values. Option would be the same. So, and we'll use condominium associations, and we'll real quick talk on co-ops, just because you mentioned the $250 per unit. So, for a condominium association, the building can insure up to $250,000 per unit. How long has that been? Because I don't remember it being anything else.
I don't.
Now that we're having this discussion,
Honestly, as long as I'm going on 29 years, it's always been that amount.
because they might have to increase that at some point. I was just thinking that.
Well, they've talked about it. They've talked about it several different times. That conversation has been had, but they've just never increased it.
So if you've got a building, we're going to use easy math because it's still morning and brain hasn't fully gone onto the caffeine. So if you've got a building of 10 units, you can insure it for $2.5 million in flood, maximum coverage.
As long as the appraisal,
But even if the appraisal is more than 2.5,
you can only go to 2.
you can only go to 2.5.
Correct.
I haven't had a lot of that happen, to be honest. We haven't had a ton of appraised values that have exceeded that. Where we see that happen frequently, and we work together on one of these, is co-ops. So cooperatives have a different rule. I think it's $500,000 per building.
Well, it's not specific to cooperative. That's
Yeah.
because it's a commercial.
But not if you have a commercial condo, it doesn't work that way.
I think it still does because the residential condominium is the only one that's the 250. So you can't use the RC BAP on a commercial.
So
unless the commercial condo files 718.
Right, but so if you've got a commercial condo, We'll look this up.
Well,
We're
yeah,
gonna have to
check
check
that.
this. But I was under the impression that like Bayfront, as long as I might be mixing something up in my head with tax returns, but that as long as more than 50% of it was used for residential purposes.
You're talking mixed use.
Yeah, I'm
That's
saying,
a
yeah.
different
Oh, yeah. Let me
scenario.
rephrase this. The whole, but I'm saying, because for us, our whole, when we do commercial, we're dealing with mixed use, and so I thought our mixed use condos could.
Correct.
Okay.
You're correct. As long as that 50% threshold exists, and that you have to get into the real details of the building, the square footage, all those things come into play. But yes, you're right. If it's a mixed use building and it meets all that criteria, you can still do the 250. If it doesn't, you're stuck at the 500.
All right. And then if you're stuck at the 500,000 and you do need more,
You buy excess.
you have to buy excess flood.
So there's a lot of confusion. Let's talk real quick about excess flood. A lot of confusion because of the fact that, again, this is really a little bit more relative to the elevated structures that have the lobby areas and stuff like that on the first floor. Excess flood only comes into play if the full limit of your policy has been exhausted. So let's say I have a condo on Gulf Shore, luxury high rise, valued at $80 million. But because of the 250 per unit clause, I can only buy $30 million worth of coverage based on the number of units in there, right? Unlikely you're going to get to $30 million worth of damage. I mean, even with Ian, rare that we ever saw that limit of damage. The confusion came in for some associations was that they had their loss. There were some uncovered items that they thought they could use their excess flood on. That is not how excess flood works. Excess flood only works if the total limit of the policy is fully exhausted. So in a co-op, let's say we've got a $8 million building. I can only purchase $500,000 because of the fact that I have to use a commercial form on it. They would benefit more from a excess flood policy than that $30 million limit on the $80 million condo, because the likelihood of getting to 30 is very minimal. The likelihood of getting to 500 is very real.
All right.
So I would always look, if I'm doing a co-op, I would look at presenting excess flood. And again, it's not inexpensive. It's going to cost something, because if you look at it from the carrier standpoint, they're looking at the, actuary tables. They're looking at the potential of what the loss could be. And if I've got an $8 million building and only $500,000 worth of coverage, it's much more likely to have to be used, because it's not that hard to get to $500,000 worth of damage. Versus trying to write excess flood on that other thing, they know the likelihood of getting over 30 million is so minimal, they can price it more.
Makes sense. All right, we're going to take a little break, and we're going to come back. We'll talk about the flood resource maps and LOMAs and Risk 2.0 and all of that kind of stuff.
Great.